Hello and welcome to the show. After many days of steep sell-offs, a tiny bit more stability to the equity markets today. The question everyone, though, is wrestling with is what is the real impact of the coronavirus on the global economy? And here to help us think that through and the impact on equities is David Sykes. He is head of active equities at TD Asset Management. What a time to bring you on, but thanks for coming.
You're very welcome. Nice to see you. It's a very interesting time.
Yeah, it is. So let me ask, what are you looking at right now to try and understand and gauge where things are? It seems like the market's caught up to the narrative. There's going to be an impact here. So what are you looking at to see how big the impact will be?
Well, if you had told me back in December that this virus news had hit the airwaves, I would have certainly thought the market would be much lower. But we've had a very strong Jan and Feb. And to me, it does seem, though, now the big issue is that it's no longer just a Chinese issue. We've now seen the spread of the virus to South Korea, to Iran, to Italy. And I think that's really been the tipping point for the market. In the last few weeks, you started to see the price of gold spike higher. You started to see the 10-year Treasury, the yield really, really drop. And so you've seen a spike in the VIX index. But I think your question is at the heart of the virus and the heart of the analysis, which is how big is this going to be? And I don't really think anyone truly knows. And we're all trying to find that next bit of information to make that determination.
And I think, what we're hearing from, many people, we're starting to see some downgrades from companies in terms of earnings. We just heard from Microsoft. But, when does this kind of get baked into, economic forecasts, when people actually start to downgrade those as well?
There's absolutely no doubt whatsoever this is going to have an economic impact.
Yeah.
Absolutely for sure. I suspect you're going to see negative growth in the first quarter from China, perhaps even the second quarter. But I think the market largely knows that. I think they're not surprised by that. To your point, you've seen Apple issue a guidance warning. We saw MasterCard do the same thing. We've seen auto manufacturers in Eastern Europe say, we can't get components from China. Clearly, this is going to have an economic slowdown. And what we really care about is what does that economic slowdown mean to corporate earnings? Because at the end of the day, corporate earnings, those corporate profits drive stock price, which is what we're interested in. And from our perspective, I'm not so sure we're fully baked in yet. There's going to be a period here where this could go on for, 6, 8, 10 more weeks. Hopefully not quarters, but we'll see. But it does seem to me that the incidents and the cases in China are slowing, but unfortunately they're spreading in other countries. And that's, I think, what the market's trying to grapple with. What happens if this goes to the United States? What if this shows up in Paris? That's a bigger question. And
we'll talk a bit about that, too, because I guess there's a couple of things. What does it mean for supply chains, which you mentioned? What does it mean for people to stop doing things, like stop going to work, stop living, the demand shock? But before I get there, what about the offsets that could be in place? In China, we're hearing about some stimulus, in terms of allowing, I think there's, some companies that have to pay insurance premiums you get a let on that. Or, in Hong Kong, I know there's been some payout to some citizens as well. So could that mitigate it a bit? Yeah,
and I think it's very important to remember that the Chinese government and other governments across the globe are not asleep at the switch. Everybody is focused on this issue. In China, you've seen interest rate cuts, you've seen tax cuts, licensing fees, levies reduced. In Hong Kong, it was announced today that every Hong Kong citizen will receive about $1,300 directly from the government to add stimulus. Governments are pouring money at this. They're not asleep at the switch. Lots of speculation that the Fed may reduce rates this year because of the virus. So, it's not good news, but the good news is that governments are aware, they're watching, central banks are watching, ready to add liquidity if needed.
Yeah, but they've got a couple tools that they're ready. I know they can always cut interest rates, but they can only go so low because they're already there. But you could do other things. Is that really going to be the solution? Do you think to a lot of this? Is just turn to the Fed once again?
It could be, but the interesting part about this is, I think we, in some senses, have seen this before. We've been through this with SARS. Back in 2003, you had a very quick sell-off, equity markets down 10, 12, 14%. In the last few days, we're down 8%, a very, very sharp drop. But I wouldn't want to get too carried away unless we have more information. I think it's important to remember that this is a flu. It's very nasty and it's causing lots of health issues. But I think at the end of the day, if we look out 3 months, we're not exactly sure. But I'd be willing to say, in 3 years from now, we're going to be well beyond this. And there's always something to worry about in the equity market. If it's not Brexit, or if it's European sovereign debt crisis, or it's Trump, or it's trade tariffs, there's always something to worry about. I think this is a little bit new. I'm not a doctor. I'm not an epidemiologist. But my team and I, we do know the markets. And we're getting to a point now where stocks have given a lot back very quickly. And there are I think, some interesting opportunities.
I want to get the opportunities. Just the one last thing, though, in terms of demand shock. I mean, we are seeing, obviously in China, people aren't going to work. They're not doing things. They're not spending. Is that something, do you think, that's fully priced in right now, or maybe it's priced in too far?
I think it's priced in with as much information as we know. So if we make the assumption that there's a few more cases in South Korea, it comes to the United States, but not in a very severe way, we're probably more than baked in. Mm-hmm. But the question is, when we wake up tomorrow or next week or the week after, did the incident rate continue to climb, or have we truly contained? And I think that's what the market's grappling with. And Kim, honestly, no one knows the answer to that question. Yeah. I think a lot of people, a lot of commentators, a lot of analysts think they know the question, but I don't think anybody truly knows the answer to that, and that's why it's a market.
Let me ask you then, just to pull it back then, we see the news, we see the headlines. I mean, it's going to get, maybe from a breadth of where it's going, it's going to get worse before it gets better. But when I'm watching my portfolio drop, like what it has with like the S&P in the past little while, it doesn't feel good. So what should investors be taking from this?
To me, it depends on what's the objective and what's the plan. And so let's go back to first principles. And if you need that money next week, okay, maybe you should feel very nervous. But if you need that money for a college fund, if you need that money for retirement, I think there's been a lot of good news people have missed. And over the last few weeks, one of the things I've been really happy about is that CN Rail, a great Canadian company, increased the dividend 7% for the 20th year in a row. We just had an announcement from PepsiCo, a nice consumer staple stock, increased the dividend this year for the 47th year in a row. Home Depot announced a 10% dividend increase. There are so many great companies inside Canada, inside America, in great shape. This is a hiccup. It'd be my thesis that what we're going through now is a delay in demand. It's a delay in consumption. It's not a destruction. Now, could I be wrong? Sure. Could this end up being something much, much bigger than we think? Yes. But authorities are on this. The medical community is on this. And if you take that approach, I think these are the opportunistic times to really add to that portfolio great quality companies. Quality starts with balance sheet, not a lot of debt. If you've got a demand problem, sales decline, and you can't make those debt payments. Yeah. But if you really focus on that quality piece, you may not wake up in 3 months feeling great, but I think you're going to wake up in a year or 2 or 3 feeling much better.
All right. Well, we'll have you back sooner than that, and we'll see if that thesis holds out. David, always a pleasure.
Thanks very much.